Hello students, welcome back. What we're going to review today is several concepts about fund accounting. Well, when we speak about fund accounting is mainly a system of accounting used primarily for nonprofits or government organizations, just like the name of this course. For these and other similar organizations, it's more important for them to keep a record of how their money was spent, rather than how it was earned, unlike corporations who are mainly there for a business setting, to make a profit. Their accounting records take the form of a collection of funds, each fund having a distinct exact purpose, ranging from operating expenses to funding the various activities of the organization, and so on. So the fund accounting strategy was effective in explaining the situation to us. All records were organized and correctly documented. So all of these records within fund accounting, within government organization, is just mainly for records to know exactly where the money is flowing to. Now we do have something called the general fund. When you think about a general fund, it's mainly going to account for all the financial resources not accounted for in other types of accounts. And when you think about it, think about your bank account, right? Your bank account may have several sections for gas, maybe for food, based on your statement. So on a credit card statement, it may categorize it. But on your credit card statement, when it's categorized, what if you allowed somebody to have a cash advance and for them to borrow money? Where does that go, right? So being that everything usually needs to be categorized, in short, general funds are there for all the uncategorizable type of items or all the small items that don't usually happen. Okay? And again here, as it's saying, is that the general fund has many resources that have no limitations on its use and do not require segregation. So it's just kind of like a big pool of an accounting account that I don't really know where this should go. So I'm going to put it in the general fund. That's how many organizations use it. But then you have something called the special revenue funds. And within the special revenue funds, it's going to account for and report the proceeds of specific revenue sources that are restricted or committed to expenditure or a specified purpose, right? So with that being said, if it's gas in this example, then we're going to categorize it in the gas account. And when we think about something called restricted or committed, restricted means that you could only use it for certain purposes. So for instance, in a college setting, if somebody were to donate $10,000 and tell us that you have to spend it on student books, then it's restricted. That means that whatever they've given us can only be used for X, Y, and Z because that's what they told us it's for. Right? So everything has its certain type of limitations, and based on the limitations of the word restricted, you could only use it for certain things. So to reiterate here, we're going to go on to the next slide and learn more about special revenue funds. In short, a special revenue fund is an account established by a government to collect money that must be used for a specific project. So that's the key element here. It must be used for a specific project. Special revenue funds provide an extra level of accountability and transparency to taxpayers that their tax dollars will go toward an intended purpose, hence the word special purpose. Governments must rely on operating and capital budgets to pay for their expenses. Okay, so just breaking it down a little bit, for example, a city might establish a special revenue fund to pay expenses associated with storm water management. The money in this fund could only be used for storm water management costs, such as street sweeping, drain and ditch cleaning, system maintenance, and public education. The city would be required to publicly report on where it collected the special revenue fund money from and how it was spent on special revenue funds. As indicated on this slide, there's a slight contrast between accrual and modified accrual basis. As indicated here, accrual recognizes revenues when they are earned, and what that means is the cash doesn't exactly have to touch your hands, but you're generating the profit based upon what somebody promises you to pay. And essentially, you're going to match expenses with the revenues when resources or services are used. So in the event that you do something for a client and they're supposed to pay you, you're going to record those expenses in the same exact period. So for instance, if you did it in the first quarter, from months January to March, then you would record the expenses and the revenue in that same period. Now we do have something else called the modified accrual basis of accounting. The modified accrual is a combination of cash basis and full accrual basis. Revenues are recognized when they are both measurable and available. By measurable, I do mean the cash flow from the revenue can be reasonably estimated. So that's an important aspect, maybe estimated because of an invoice. And available, which means that the revenue is available to finance current expenditures to be paid within 60 days. Expenditures, however, are recorded on a full accrual basis because they are always measurable when they are incurred. The measurement focus of governmental funds affects which transactions are recognized in the operating fund. If transactions are not a current resource or use, they are not reported in the operating fund or the fund financial statement. So in this example, we're assuming that the property tax for 2015 is $1 million, and 800,000 of it is going to be collected in 2015. So the scenario here is that 120,000 of it is going to be collected in January and February of 2016. But 80,000 of it is collected later on. So because the property taxes are expected to be collected within that specific time frame, within 60 days of the last period, anything over that 60-day period will be accounted for the next year. So in this case, although $200,000 has been accounted for in 2016 to apply for the 2015 taxes, only 120,000 of it is going to be used for 2015 because that's the payment that was within that 60-day period. The 80,000 wasn't accounted for. So as we can see here, it's going to be recorded as deferred revenue as opposed to cash. Now, this is another thought process that we have, uncollectible amounts. These uncollectible amounts are allowance for doubtful accounts, right? The allowance for doubtful accounts is a balance sheet account that reduces the reported amount of an accounts receivable. Providing an allowance for doubtful accounts presents a more realistic picture of how much of the accounts receivable will be turning to cash. I mean, after all, a company selling products or services on credit to thousands of customers will likely have a few customers who will not be able to pay the full amount they owe to the company, right? And we need to account for that because I'm pretty sure that not everyone is paying their taxes at the same rate that they're supposed to pay it. So there's going to be usual an allowance for that $75,000 because the revenue is usual the $1 million based on their records. At times, accounts are written off, and When we often hear this term write-off, accounts written off often refers to the accounts receivable that were deemed to be uncollectible and were removed from a receivable account in the general ledger. For example, a manufacturer may have written an accounts receivable because a customer filed for bankruptcy and has sufficient assets. So anything that you know about the customer that indicates that they will never be paying, you usually write them off. And sometimes what happens is that you send them to a collection company. You send them to a collection company and they try to retain the debt from that individual. We also have a concept of short-term borrowing, and it arises from short-term debt. Short-term debt is an account in which current liabilities portion of a company's balance sheet. This account is made up of any debt incurred by a company that is due within a year. The debt in this liabilities account is usually made up of short-term bank loans taken out by the company, among other types. Well, as anything, especially with our student loans, everyone needs to make money off of something, right? So if you're able to borrow, in this case, $250,000 and the interest rate is 6% for 3 months, then you're going to be charged $3,750, right, on that account, which ends up being $253,750, which is the final number that you'll pay off based on that borrowing. Now, we do have a concept of interfund transactions. Within interfund activity takes place among governmental, proprietary, fiduciary funds, as well as blended component units in the fund financial statements, such as transfers and their associated due tos, due froms, and revenues and expenses or expenditures with their associated receivables and payables. The interfund activity within fund statements will have to be analyzed and classified and or eliminated in the government-wide statement of net assets and statement of activities. The interfund activity reported in the fund statements could be either reciprocal or non-reciprocal. As we indicated, the interfund transactions can come in different parts, right? So you have reimbursements and transfers mainly. Sometimes called quasi-external transactions, these transactions, typically services between funds, are exchange-like transactions. So what we're doing is just kind of transferring within the same type of funds. So a good example of this, as it indicates on the bottom, is the sale of electricity by the Electricity Enterprise Fund to the general fund. So basically, we're just transferring funds based on our usage in our own organization. Now, reimbursement, sometimes we just reimburse one fund to another. As it says here, initially one fund pays for a good or service for another fund. And as it indicates, when the reimbursement is made, the expense or expenditure is recorded in the correct fund. So all we're doing is reversing it afterwards so that we can account for the reimbursement within the fund.